Retail Property Financing 101. And retail real estate remains one of the most popular commercial property sectors for investors and for business owners. From neighborhood strip centers and standalone retail buildings to multi-tenant shopping centers and mixed-use developments, retail properties can generate strong cash flow and long-term wealth when financed properly. And understanding how retail property financing works can help investors secure better loan terms, improve their returns, and avoid costly mistakes. So what is retail property financing? And retail property financing refers to loans that are used to purchase, to refinance, to renovate, or to develop retail real estate. So some common retail property types can include grocery anchored retail shopping centers, strip centers, neighborhood retail centers, standalone retail buildings, restaurant properties, drugstores, convenience stores, triple net retail properties, mixed use retail developments. And lenders evaluate retail properties differently than residential properties because they focus heavily on cash flow, on tenant quality, on occupancy, and property performance. So what lenders look for when financing retail properties, lenders typically evaluate occupancy, and higher occupancy generally reduces lender risk, as well as for yourself, the investor. But preferred occupancy often exceeds 80% to 90%, and 85% is general rule for stabilization. But also tenant quality is extremely important. National and regional tenants often receive favorable treatment because they provide stable income streams and often come with corporate credit backing. And some examples can include, say, a Starbucks, a Walgreens, a Dollar General, a Chick-fil-A, a Walmart neighborhood market. But net operating income, or NOI. NOI is one of the most important underwriting metrics. And lenders want to see that the property's income can comfortably cover the debt payments that they're going to be extending a loan for. So debt service coverage ratio, or DSCR, and most lenders prefer a DSCR between 1.2 and 1.35, generally north of 1.35 for a bank option is something I've found. And a higher DSCR demonstrates stronger ability to service debt. Property location. So strong demographics and traffic counts and visibility and population growth can improve financing options. So let's talk about some common retail loan options. We've got bank loans, and those are best for owner users or for local investors or for stabilized properties. And some typical features would be competitive rates and 20 to 30 year amortization periods and 5 to 10 year fixed periods, and recourse is often required. Credit union financing. And credit unions often offer flexible underwriting and attractive terms for local business owners. And these are best for smaller retail properties and owner occupied buildings, and they're relationship type borrowers. There's SBA loans. So for owner-occupied retail properties, SBA financing can be one of the most powerful tools available. And some programs there include the SBA 7A for acquisition, for working capital, for equipment, or for business expansion. But there's also SBA 504 with lower down payments and longer-term fixed financing for real estate acquisitions. But there's also CMBS loans. Commercial mortgage-backed securities, or CMBS financing, works well for larger, stabilized retail assets. And some benefits there will be non-recourse options, but competitive rates and longer terms. So some considerations to be aware of. There's more complex servicing. There's generally prepayment penalties. Life company loans. Life insurance companies often target higher quality retail centers with strong sponsorship, and they're ideal for long-term investment property holds. And some benefits include competitive rates and longer fixed periods and flexible structures. But there's also debt funds and bridge loans. And bridge financing helps investors acquire underperforming properties, but also to fund renovations, that improve occupancy, but also to execute on their value add strategy. And these loans generally close faster than conventional financing. So, how much down payment is required? Well, typical retail property down payments can range from 10 to 15% for certain SBA programs, to 20 to 30% for conventional financing, to 25 to 40% for value add opportunities. And there's higher equity requirements for construction projects. And the stronger the property and the borrower profile, the more aggressive lenders will become as far as pricing and terms. So, some documents that you're going to need. Most retail lenders will request a rent roll and current leases and a T12 operating statement, but also a personal financial statement and real estate schedule, but tax returns, organizational documents, property photos, and a purchase contract if we're buying it. So the point here is preparing your documentation early can significantly speed up your loan approval. So let's talk about some retail financing challenges. And here's some common issues that can impact loan approval. If you have a center with high vacancy or short-term leases or tenants concentrated in one particular area or business type, but if there's deferred maintenance or if there's weak market conditions or declining tenant sales. And understanding these concerns allows borrowers to address potential lender objections proactively. So let's talk about how technology is changing retail financing. And historically, commercial borrowers had limited visibility into lender options. And today's technology-driven marketplaces allow borrowers to access hundreds of lenders and thousands of loan programs much more efficiently. And CommLoan's CUPID technology helps match borrowers with lenders based on the property type, the borrower profile, and the financing objectives, while accessing a network of more than 700 lenders nationwide. And this creates more transparency, additional financing options, and faster lender matching. So, final thoughts for the day is that retail property financing is about much more than securing the lowest interest rate. The right loan structure can improve your cash flow and reduce your risk, but also increase your flexibility and enhance your long-term returns. So whether you're purchasing a strip center or refinancing a shopping center or acquiring a net lease property or expanding your business into an owner-occupied retail location, understanding available financing options is critical to your investment success. And working with an experienced commercial mortgage advisor can help you compare lenders, evaluate loan structures, and identify financing solutions that are better aligned with your investment strategy. And that, my friends, is it for the day. Thank you for taking the time to watch. Please visit my website, billrapp.comloan.com. You can schedule a consultation there. You can also do a preliminary pricing check. Love to talk to you more. Thank you for watching. Have a good day.